Welcome back to the Manor. Julian McBain here, and we're back with Personal Finance for Gamers. And today, we're going to be talking about bonds. A couple of housekeeping things before we get into that, though. First off, as you all know, I have completed my Boneworks run through, and I have been putting together the videos for that. And my first true video editing project. I also have the trailer I made a couple weeks ago up on YouTube, and I have some Halo clips that I've been posting to Twitter at Julian McBain, although admittedly most of my stuff there are all, political shit posting, so whether or not you even want to go searching for them is totally up to you. But this week the first two episodes drop. They are my first real work put into them, edited videos. I'm working on putting transitions in and doing all the things. Little commentaries were necessary. So please go check those out as they come out. I'd love to hear feedback. Okay. Also, before we get all the way in, if you're new to the channel, welcome to the Manor. Please take a moment and subscribe down below. We're on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. Also, please consider going to patreon.com/JulianMcBain if you want to support my work. It is the patronage of my patrons that make me able to do these videos as well as I do them, to be able to do things like invest in the software I bought. So if you want to continue helping me to produce this content, if you like what I do, please consider becoming a patron. Okay. Time to talk about bonds. First off, what's a bond? Well, as you may have figured out from previous videos, a bond is a debt instrument issued by a corporation or government entity. And it's very important to know that there are various entities that can do this. And I shouldn't just say corporation, because other forms of companies can do it too. Corporations are the most common. LLCs could theoretically do it, although in practice I have not seen any that are on the open market. They might do a private issue of bond to their own membership, but they would still be classified as bonds, even though that separate rules apply to them. So you've got corporate bonds, U.S. bonds, which are issued by the federal government. These are best known as T-bills or T-bonds, money markets, things like that. They're all issued by the federal government, and this is how, when you see the U.S. federal government debt counter, that's what they're creating the debt with. It's these bonds. Also, states, although less common, and municipalities can issue bonds as well. And municipal bonds are pretty interesting. They have some unique features. They vary from municipality to municipality very, very little. It would be worth your while if you are in a high tax bracket to talk to an investment advisor about municipal bonds over corporate bonds, because generally speaking, municipal bonds aren't taxable. So that's the unique element to municipal bonds. U.S. bonds are not federally taxable. I believe it's federally. Yeah, because you can still get taxed on them by the state, but not the... Okay. Bonds are generally denominated in $1,000 increments. They're actually priced in points, which are 1% of the bond when you go to find them on the market. 1 point is usually $10 because most bonds are $1,000 bonds. There are rare exceptions. We're not getting into that, but for reasons, corporations decided $1,000 was the right way to go. They provide an interest rate that is in line with the prime rate. This rate does not adjust over the life of a bond. Most bonds, not all, most bonds have 30-year terms. They can be shorter. In theory, they can be longer, but in practice, most of the bonds you'll run into are 30-year bonds. You buy the bond for $1,000. It has a 5% interest rate. You get $50 a year for 30 years. You turn the bond and you get your $1,000 back. Also, bonds can be sold on the secondary market, corporate bonds especially, but this is true of municipal bonds as well. Basically, you can purchase the bond for $1,000. If the interest rate moves, it adjusts the price of the bond. You can sell it on the open market, or if you don't want it anymore. So, The price of a bond, speaking of which, fluctuates with not with the supply and demand of the bond, but rather the interest rate. See, a bond is evaluated based upon its value to maturity, which means how much interest plus the value of the bond is provided when you purchase this bond off of someone, because that total value of return is what you're going to look at. As interest rates go up, value of bonds go down, because a 3% bond is not going to do as well in a 4% bond market. There's less incentive to buy it. Therefore, the price of that bond must go down in order to make up that gap. Hang on, just... Allergies are a bitch. Conversely, when interest rates go down, higher interest denominated bonds go up because the amount you're getting on return on that bond is greater than is expected in the current market. These are called discount and premium bonds, respectively. So there is a bit of an offset there for value, because it can also be affected by the number of interest payments remaining on the bond. For instance, a 30-year bond that's 10 years old is not going to be worth the same as a 30-year bond that's 5 years old, because there's more interest to be paid on it. Okay. So I kind of put this at the end, but I think it's important to jump into here before we go into any more mechanics of a bond. What is the value of a bond over, say, a stock? And that's a great question, because bonds are both more and less complicated than stocks when it comes to trading. You have to understand the mechanics of bond valuation, which is more complicated. But receiving your dividend, your interest payments from a bond, because they're interest payments, not dividends, but your returns from a bond, is far simpler than a stock, because it simply pays out twice a year based on the annual percentage rate of the bond, or annual percentage yield of the bond. So what does that mean? Well, if you've got a bond, face value is $1,000 like most bonds, it's got a 4% APY on, or APR on it, which means it pays out $40 a year. Then you're going to get two $20 payments per year. And you're going, well, what good is $20 every 6 months to me? And it's like, well, if you think about it, I'm going to pull out my handy dandy calculator here. If you get $40 a year times 30 years, for the $1,000 loan you gave that corporation at 4%, you're getting $1,200 in interest over the life of the bond plus your $1,000 back when it's time for that bond, when that bond finally matures. So you made more than the value of the bond back, plus you got the value of the bond back. See how that works? That's only at 4%. Corporate bonds can often go like 8%, which is a hell of a lot more. And you don't ever buy one bond. Generally speaking, if you're going to buy bonds, you buy like 10. So you get $400 or $200 every 6 months. Still not a huge amount, but a hell of a lot better. And if it's actually 8% instead of 4%, it's $400 every 6 months. Do you see where this is going? So the value in bonds really comes to their stability. Bonds are called fixed rate securities, which means you get a fixed rate of return over the life of the security without any deviation. And if a bond carrier fails to pay the bond defaults, and then that company may be subject to liquidation, which means you want to pay attention to the valuation of the types of bonds you're investing in. We're going to get into that toward the end of the video, but I wanted to throw that out there. If you're investing wisely in bonds, the likelihood you're going to lose principal, especially if you hold that bond all the way to maturity, is relatively low to that of most stocks. Blue chips are excluded. Those are your really high cap companies that are not very volatile at all. Think big box department store, or the big box department store that doesn't actually have stores that you get in the mail all the time. Blue chips. So The value in bonds is that your principal is far more safe than in a stock. That does not mean it's absolute. But even if the bond were to lose a bunch of value, say it goes from being worth 100 points, which is $1,000, down to 30 points, which is $300, as long as you hold the bond to maturity, you still get $1,000 back when you turn it into the corporation at the end of the life of that bond. So it's one of those things, and this is a real life thing I heard on a phone conversation with an investment advisor that was mentoring me when I had my Series 65. And he's like, I have this conversation, I want you to sit in on this call. And the customer was complaining because his bonds were going down and he was losing value on his portfolio, on the face of his portfolio, because the bond values were going down because interest rates were going up. And the investment advisor talks to him and he says, "Customer, are you planning on selling these bonds or not?" And the customer's like, "Well, no. I want the income and I don't see any point in selling them if I can still get the income." He goes, "Fine. Then don't worry about it, because when you turn these bonds in at the end of their maturity in another 10 years, you're still going to get $1,000 regardless of what the face value of the bond was." And after he explained that, the customer shut up. Now, there are versions of bonds that can be called. We're not going to get into the more nuanced discussions about this. Please consult your investment advisor before making any individual investments. But if you're looking for income with lower volatility, investment grade bonds are the way to go. Again, we're going to get into grades here toward the end. Okay, so we got into the number of payments remaining on a bond affects its value. I went through the way that interest is paid on bonds. Oh, what is interest on a bond? Okay. The rate of your bond is going to be based on the prime rate. The prime rate you can look up. The Fed sets it. It's been really low for a really long time. For those of you who are watching this when it comes out, the Fed has already stated they're going to increase the prime rate several times in 2022. That prime rate affects what you pay for loan interest, because you pay what's called prime plus a margin. The margin is the amount of interest you pay over the prime, usually based on your credit worthiness. Corporations are no different. They pay prime plus a margin based on their perceived credit worthiness, usually, in order to make sure that you get the return on investment based on how secure your dollars you lent them are. And this is where investment grading goes into effect. And there are two companies that do this, Standard & Poor and Moody's. Both are quite famous because the Standard & Poor, they're the S&P kids. They're the big names that have their own, their 500, the S&P 500. That's the S&P. Moody's is really famous because they seem to manage to figure out every investment trend on the planet. They're like super geniuses over at Moody's. And I say this, and I'm not saying this because I work for a company, one of the highest rated insurance, or I work for an agent to one of the highest rated insurance companies in America, rated AA on Moody's. There is no insurance company that's AAA rated. But I say this because there's a reason that everyone trusts Moody's. So there are two gradations, investment grade and junk, or high yield. Investment grade are those bonds that are considered to be safe or relatively safe. There's no such thing as an absolute safe investment. Don't let anyone convince you of it. Don't let anyone con you into it. No such thing as a 100% safe investment. There ain't no crypto that's 100% safe, not even Bitcoin. There's no corporation that's 100% safe. We learned that in 2008. But there are those that are highly unlikely to be problems. I'm going to give some examples. I'm going to name 3 corporations that are highly unlikely to go to self-immolate the way Bear Stearns did. JP Morgan and Chase. Not likely to self-immolate. They've been in trouble before, but they made it out, right? In fact, all of the big four major banks, your JP Morgan, your Wells Fargo, your Citibank, and your, what's the fourth one? They're even bigger than Citi. Bank of America. Right? None of those are likely to self-immolate. In fact, they've been considered systemically important, which too big to fail. We won't get into too big to fail. We just won't. Other major corporations that might be considered on the quote-unquote safer side are Walmart and Amazon, the heretofore mentioned big box stores. Now, these are not investment recommendations. Your own investment needs will tailor how you want to invest in things. The reason I mention these companies are because these are companies that are so big and have such a huge impact. If these companies crash, you're probably looking at a much broader systemic problem in the system, as we saw back in the 2008 financial crisis and beyond. This is why they're considered quote-unquote blue chip. Again, this is not financial advice. I'm providing examples of what is a definitional of a definition for a definition. Okay. This is educational content only, FINRA. Don't yell at me. And yes, I do have to put disclaimers like that in these videos because I'm still subject to FINRA monitoring for another year and a half-ish, I think. Maybe it's only a year. It's been a while. But I'd like to get my 65 back at some point. And I will get into the story of my 65 in the next video. Because it's relevant to the next video. Because we're going to get into some of the fancier, some more common, some less common investment types. So, investment grade bonds, lower interest rates, higher class of company issuing them, very unlikely to default. High yield, aka junk bonds. Exactly the opposite. High interest rate, which means you're getting a higher return for your risk at a higher risk. Good chance that they will default. Like if you buy a junk bond, you're placing a bet. That being said, if you win the bet, you yield a much greater result than you would if you had bought an investment grade bond. Fiduciaries, as a general rule, especially as you get older, will not go into junk bonds, will only go into investment grade bonds, or will invest in funds that are primarily investment grade bonds and not junk bonds. Bond funds can kind of play the gap. Accredited investors aside. And we're going to get into accredited investors in the next video. So, bonds are a fixed income security, as mentioned previous. You get the income for the stated length of the bond, and then you get your money back. What's the benefit to this? Stability. If you have $100,000 in 8% bonds, right? So that's 1,000 bonds. No. Yes. No, that's 100 bonds. What am I thinking? It's 100 bonds at 8%. That's $800 a year per bond. That's $80,000 in income per year from those bonds. Okay? Pretty simple math. And you're going to get that $80,000 every year for the entire time you have all 80 of those, or all 100 of those bonds. And that's how a lot of retirements are operated. Usually they're invested in bond funds. We're going to get into mutual funds in the next video. And basically what they do is they buy a bunch of bonds from various companies and then distribute the net income to the owners of the mutual fund. But if you're retired and you're really worried about making sure your money lasts until you die, bonds are the way that most investment advisors will invest your money, or they'll put them in mutual funds that invest in bonds. Good fixed income securities, good, but not if you're looking to grow the size of your portfolio, other than to reinvest the interest into more bonds. This would be a very conservative investment strategy. And investment strategies are things we're going to get into in a later video. Again, it'll be educationally purposed, not for the purpose of you trying to figure out what your strategy is per se. You can take that information, bring it to a professional investment advisor, and say, hey, I've heard of all these strategies. I'm sure you have more that are more modern. What is your advice to me, someone with X number of dollars to invest? And that's how that conversation should go. So, okay, those are bonds in a nutshell. A 20-minute nutshell, but a nutshell. Thank you for watching. Thank you for listening. Please like, share, and subscribe down below. We are on the road to 13 million subscribers, one subscription at a time, so make sure you subscribe. And as always, I really appreciate the support. Huge shout out to my patrons, Red Crypto Knight, Jay Lambertson, Devin327, Melky, and Robert J for all of your support. And we'll see you in the next one.